Hopefully the computer holds in today. It's actually been giving me some issues. Had some issues this morning. Apologies. Thursday. I have so much difficulty sometimes keeping track of the day of the week. It's like hard. It's harder than trading. Today's Thursday, May 18th. 10 after 4 Eastern. You guys can hear me, right? Nobody said anything. Usually somebody says something. Anybody out there? Cool. I am an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. There is the position disclosure. There are no changes from yesterday, I don't think. Cool. What's up, Dave? What's up, Aaron? What's up, Eddie? John, Nick? And to the other 100 or so of you who don't like to say hello to me, I'll say hello to you guys anyway. What's up? What's up, guys? All right, let's hop over here and talk about the stock market. Oh man, what a crazy couple of days. Let's do an overview of the market. I want to talk about a couple things specifically related to execution and day trading versus swing trading and stuff like that, just because I've had a bunch of comments over the course of the last couple of days, especially today, about different things from different people. So let's start with an overview of the market. S&P closed up a percentage point. Q's up 1.8, unstoppable. IWM relatively weak, only positive 0.6%, and spent a good day of the day negative. Not what I want to see. Let's take a look at some daily charts. So I was a little nervous about today. We discussed this in the morning meeting. You know, I wanted to be. Who was at the front door? I wanted to be. I wanted to be really bullish this morning, and I woke up and I saw where the market was trading pre-market. We're at 416, and at first I was like really excited about this gap up into this 416 area, which has been pretty big resistance for the SPYs, especially given the breadth improvement from yesterday, the IWM improvement from yesterday. I wanted to be excited, and then I just started typing up some of these big cap tech stocks that have had such big moves. I'm just looking at so many of them that are starting to get like a little overly extended to the upside. So I'm thinking it's going to be tough for these to give a real another leg up. But you know, maybe we could get some continuation if we get some real rotation into some of these other sectors. If financials can give a second day, if XLE can begin to improve. But I'm also like, you know, that KRE gave a massive day into this second resistance area, about $40. That might struggle to continue also after such a big day. So I'm glad about the improvements, but I think today is going to be difficult for continuation. And then in conjunction with that, I'm looking at the dollar strong. I'm looking at TLT gapping down. I'm looking at the information that Pat's providing about the probability of a rate hike increase from the Fed starting to creep up a little bit for the June meeting, and the probability of cuts into the back half of the year, which I've been saying from the beginning is unlikely to start to dissipate a little bit. And I was like, man, you know, I just think it's going to be really difficult for us to actually break out of the range today, even if we're testing it. I thought that the most bullish thing that could happen today would actually just be kind of sideways price action in front of that resistance if we get like a smaller doji day. And then maybe we could set up for tomorrow. Some of those extended FANG tech stocks that have really been lifting us higher could have a little bit of a healthy rest and set up for continuation. So that's kind of what I was thinking. And I feel like I was right and wrong at the same time. The intraday price action of the market wasn't easy. It was for the most part pretty sloppy and choppy, especially if you look at the IWM. But I got the SPYs up right now. You know, beginning of the day, first half hour, we did nothing. We caught a solid bid. We went right up to basically 4,200 and failed off of it. And failed pretty hard, pulled back pretty hard on it. I think the IWM went back negative at that point. The breadth was back to being really poor. So I'm like, okay, you know, whatever. We took this push higher into 4,200. Now what I don't want to see is a really bad close because that's going to give me a topping tail into resistance on the daily chart. But if we could just, you know, chop around the rest of the day in this 416-ish zone, maybe get a close around, you know, 416.50, a little bit higher than that. I won't have too big of a topping tail, and it'll be enough of a rest day, or maybe we can set up for tomorrow. But then we just totally exploded into the close. We broke SPX 4200, I'm pretty sure, and you can see that really right here on this bar at 3:40 p.m. and we just totally lifted off. And it wasn't a market for me to be overly excited about, to be honest. You know, I'm even looking at my swings right now. I got 16 swings on, and 1, 2, 3, 4, 5. I day traded some of them and made some money in it. Let me see here. PayPal 6. Carvana's green. I have like 6 or 7 of the 16 names that I'm swinging actually close in the negative, which shouldn't really happen on a day where the S&P is up a percentage point. But it kind of shows you that breadth weakness. It shows you that IWM weakness. It shows you that the market wasn't really participating, and it shows you that it made sense to be skeptical this morning, because it was, once again, even though I was nervous about FANG stocks not being able to give continuation, you know, I was citing Google as being too extended. Well, guess what? Google gave a day 3. Amazon, I was saying this one has news, so maybe this one could still go, and it sure did. That's a really big day 3. Apple was the one that I was pointing out to as a wild card, is the one that was really not very extended, where if this thing lifts off, it could really bring up the entire market. And Apple did go. Not a massive move from Apple. What's Apple up on a percentage basis? 1.4%, less than the Qs still, but was able to break through that 174. Meta accelerating off that upside grind that it had been in. Microsoft accelerating off that upside grind that it had been in. So, and you know, NVIDIA was sick. This NVIDIA was insane. You know, 290 was the latest breakout that we called out just a couple days ago. Okay, fine. Give me a move to 300 and change. You know, and then even today, I was thinking if early in the beginning of the day, and I never took the trade because it rested too much. In the beginning of the day, I think I was thinking like if NVIDIA could get to between like 310 and 313 early, that I'd look for a short. And then it's been the uptrend on it was just like kind of too healthy. You know, it's not. I want more, and Netflix is a little bit different because Netflix is on news. But I want more of like this parabolic extension at 10:20 a.m. like we've discussed in the past to really kind of give me more confidence on that extension short on the pullback. But yet all these stocks, they still continue, and it really helped. I mean, Netflix move is massive on this daily candle. How did Tesla do? Yeah, Tesla's okay. But yeah, at the end of the day, it was enough for the SPYs to break out. Even with relatively poor breadth, it becomes a day 2 here. So for the first time in a while, because we've been stuck in this big range, I get to start measuring extension on daily charts again. And SPYs are not that extended yet for me to begin shorting. So the ADMA is about 414. Right now we're trading at about 419.50. So we got $5.50 of extension from the daily ADMA. It's been pretty consistent for the last year plus. $10 plus of extension is where you start to look the other way, and I'm talking about extension versus the ADMA on the daily chart, and this applies for both the SPYs and the Qs. $10 plus worth of extension is really where you start really wanting to be considering hedging a long portfolio, putting shorts on, taking longs off. That $6 area of extension is usually kind of no man's land. Thanks, Nick. You're too extended to buy when you become like $6 extended from the ADMA and the SPYs or the Qs on the daily chart, but you're not extended enough to feel confident to short, because $6 of extension can easily become $10 plus of extension, which we've seen happen many times over the course of the last year and a half. So at the end of the day today, we're starting to approach that like no man's land of extension for the SPYs. Tomorrow, I'm going to be really curious to see how we gap up. If we gap up tomorrow, I'll probably look to short some Qs which are the most extended of the indices as I continue to pare down the long positions that I'm in, which I've done. I've taken off, trying to do some quick math in my head. I've probably taken off 15% or so of my buying power of my long portfolio that I'm in, maybe a little bit more than that, really over the course of the last 2 days into this upside move. So I still have a lot of long juice on here, and I'm going to follow my game plans on with that. But if we start hitting those levels of extension, that's where I continue to piece out of those longs and also begin to look to hedge myself with some shorts. So SPYs are potentially coming into no man's land. Qs, on the other hand, Qs are 337.50. ADMA is at 328.50. So we're just about there. At $10 of extension is really that spot. I often end up starting at about 9. If we can get a gap up tomorrow, it'll be a gap up into a day 3, where I'll probably start building into the short as we get more and more extended to the upside as I build out of longs. It's just been a really consistent kind of portfolio management game plan for me over the course of the last year and a half. So we'll see if that happens. I would love the gap up tomorrow. Absolutely love it. That's the type of price action where we start to really get an advantage. The interesting thing will be if the market can be up tomorrow, but the Qs rest. Like the most bullish thing that could possibly happen tomorrow, in my opinion, is that these tech stocks do nothing tomorrow, and that you get another wave higher in regional banks and financials in the IWM. The IWM, usually when you start getting like $6, $7 of extended, that's like the equivalent of that SPY QQQ $10 extension that I was talking about. So we're starting to approach that big 178 to 180 area. We're solidly above 176 right now for the IWM. So it's looking good, but there was certainly relative weakness with the Russell today, which is what we kind of identified pre-market, which is why I thought that the market would struggle to continue today. Yet continue it did, especially into the close. So the market's looking fantastically bullish, but just be careful of it getting too fantastically bullish, because you start getting parabolic, you start hitting those higher levels of extension, and at a certain point it becomes unhealthy. So it's not what you want. If you want to be really bullish on the market, you want, break higher out of the range, a new consolidation, a break higher out of the range, a little bit of a 2-day price correction back down, a break higher off that pivot low, sideways action. That type of trend continuation via a stair-stepping trend, which is basically a series of bull flags, or a pattern of higher highs and higher lows, which is basically a series of price corrections of extension over time, or some combination of the two. That's what you want to see. You don't want to see, and we're not at this point yet, but you don't want to see a market that just the slope of the upward move just begins to accelerate and accelerate and accelerate, because it's typically unsustainable. And at a certain point, if that were to happen, then maybe we need to start talking about, like, well, is there just an AI bubble that's occurring right now that could be set to give a little bit of a short-term pop, but the AI bubble is most positively impacting the highest market cap stocks, and that's why we're seeing the price action that we're seeing. Not at that point yet. We're not at that point yet, but it's just stuff I have in the back of my mind based on what the price action could do going forward. So that's kind of the overview. As far as like new day trades I took, honestly, probably not a good thing, but Baba was one of my better ones today. And the reason why I say it's not a good thing is, it's always really important that you do an honest assessment of yourself and your trades. Just because you made money in something does not necessarily mean that it was a good trade or you did a good job. And just because you lost money in something does not necessarily mean that it was a bad trade or you did a bad job. What matters most is following the rules that lead to the edge, that lead to consistency. And in this Alibaba, I was probably a little bit on tilt because I was very frustrated about the VTF issue that I had this morning, and the fact that I lost all my open orders in the market at like 9:40 something in the morning, and I was trying to get all of those orders back in, and by the time I was done with it and I typed up this Alibaba, I saw that it was starting to extend into $85. I probably took way too much risk on it and was way too big. The trade itself is somewhat sound. You know, this $85 is huge in Alibaba. I thought that the earnings report was good. This is becoming a really big level. We had that down here at 84.76, which is the last time I was really kind of trading this thing off that $85 area, and was able to make some money back then as well. And then today I got really big in this thing off this 85. And I was kind of buying on the way down for a lot of it, which is usually not always what I want to do with size, unless I have a very defined out, and my out was a little bit loose. I was probably using that 84.75 area, which was the low from the daily chart, and I got a little bit lucky. Again, the luck aspect of it was that I let myself buy way too much stock. And that could have done damage to me. It was way too heavy. If I can give myself a little credit, the skill aspect is recognizing the daily level, recognizing the extension on it, recognizing that these tails are starting to come in. But I just bought this and caught this move up to the 80 MA. I was really all out by 86.25, but I was very heavy into the $85 area. I was at the same time as I was trading this kind of parabolic move in Netflix with Pat. Pat communicated it. I was kind of just following along with him at a slightly different game plan than he did. His was probably a little bit more conservative than mine was. I was looking for a little bit more follow through, but I was out of almost everything by 364 by the 80 MA on the 5-minute chart for the technical price correction there, and then I kept a little bit of a runner in case this rolled over a bit further, which I got stopped out of it at new highs, and then I got back into and then back out of JP Morgan today. The opening dip on it, and then sold it on the way up. So those are my real day trades today. But what I want to talk about things, and I'm seeing my internet slow. And again, I highly recommend that everybody read Pat's morning note this morning, which gets into that zero DTE complex and how that has helped evolve price action into. I'm just going to push through and hope that YouTube is working. Not what I want to see here. Fuck. Hello? Test, test, test. All right. I guess I'm back. We go to either Denver or Buffalo, Wyoming for a week, and then complete the rest of the drive. I'm going to complete the rest of the drive from there over Memorial Day weekend. So I'll be back after Memorial Day. Anyway, so a few people have expressed some frustrations, and I get it, with how this market environment has been. The range-bound market environment. We've been in a range for like 2 months basically up here. And there's breakouts haven't been working in anything market related, though we've had great calls every day on individual stocks. But if you're focused on anything market related, unless you've got the 7 leaders of this market environment, you're probably a little bit frustrated. Though obviously we got some follow through yesterday and today. So if you're a swing trader in particular, these last couple weeks, unless you've got those 7 stocks, probably very frustrating if you're doing anything that's overly market correlated. Some of the names that I've been in have been really good. I've had consistently, probably 4 out of the 7 real leaders that the market has been providing on the upside. My day trading at the same time has been really good because I've been taking advantage of these ranges, which is one of the things that I want to talk about. But I'll have other positions where I'll get involved in them, and then they'll roll over and they'll not really do very much for me. So I wanted to talk about PayPal a little bit in particular because I'll use this as an example, and this is something that I'm doing with a lot of names, and it's been working really well for me while things are sloppy in these ranges. And if the bigger picture swing position works, great. I've got some stock from yesterday. I'm looking for a move to maybe $64 or $65 as a target. If it wants to get up there, awesome, I'll get paid. But I'm in a win-win situation for the position, and I don't know exactly what's going to happen. I'll give you basically one of three things that can happen with my PayPal position. One thing is that it could go down through yesterday's low and I can get stopped out of what I have. If that happens, fine, I'll make money. Just not very much, but I'll make some money. One thing that could happen is it could continue to price correct higher up towards $65, and my core swing position that I have is going to pay me really well and I'll make really good money. Awesome. Another thing that could happen, and in a lot of situations this has been the most high probability situation because we've been in a range, is that the stock ranges, right? There's a lot of ranges out there right now. And again, we're specifically trying to find names that are in play. PayPal's been moving. This thing has not been in a range. This thing had an earnings report. It gapped down from 76 to 70. It traded from 70 to 60, basically. This thing has been moving. And I would highlight that for anybody who is frustrated with the range, I've been trading plenty of stocks every day throughout this earnings season that have not been range bound because they've been news based. Whether it's that Carvana that paid me really well, or it's that Lemonade that paid me really well, or it's been to some degree these Chinese stocks that I've been trading a little bit that have paid me pretty well on a few occasions. They've all been great. The banks I have found have been generally pretty good trading vehicles, and then obviously if you're involved in Apple, Amazon, Meta, Microsoft, Nvidia, Netflix, those things have not necessarily been stuck in ranges, though they have for periods of time. Apple just went through like a 2-week consolidation before it attempted to break out today. There's been breakouts that have been working. There have been names that have been moving, but they've needed catalysts because the market hasn't done anything. So going back to PayPal, either it goes down and I get stopped out, it moves higher and I make significantly more money, or it goes sideways and I'm going to continue to get paid. Because the trade yesterday was this like RDR type trade. I bought some stock at $60.51, and then I quadrupled my position through $60.75 on the way up here. So my average price in this thing is probably, I don't know, 60 something, 60, 68, just taking kind of a guess. It's probably my average price. Stock goes up, what do we talk about? We talk about one-to-one risk coverage is a very common thing. I actually didn't do this with this name. I'm being a little bit more greedy, but I want this to be an example that's for everybody as much as possible. So you get your one-to-one risk coverage, right? If your average price is roughly the same as mine, 68, let's just call it, your stop loss is going to be 1 penny below the low, so that's 40, so your stop loss is going to be at 39, you got 30 cents risk, let's just call it on the trade, you get a move up to 60, 98 or so, you cover stock, and now your worst case scenario on this thing is that it goes all the way back down, you get stopped out, and you lose nothing. And I love that. That's one of my all-time favorite things, is when I have a failed trade and I lose nothing or even make money in it, which is where I'm at this point. If this trade fails, I'm going to make money in it. Just not nearly as much as if it actually works. And then you're left with a core position. And what you want to be able to do, and part of well, first of all, what you want to be able to do is create a game plan for yourself. What do I want to do with my core position of stock to maximize my reward? One thing that I've learned over the course of my trading career is that market environments are constantly changing. This market environment has provided us a lot of intraday volatility, but not a lot, especially these last 2 months, of big picture moves. Compare that with 2019. 2019, if anybody remembers, trading in 2019, we had a year where there was no volatility, but the market was up 30%. Right? The S&P basically had a slow upside grind the entire year of 30%, and the biggest pullback the entire year from highs to lows on the daily chart was less than 2%. I think it was like 1.5%, which is insane. We went up more than double that in the Qs today alone, right? But that's very different market environment than the market environment that we're in now. Part of the game plan that you are creating for yourself should be based on what the market environment has been. So you create a game plan for yourself, with the stock that you have to try to be able to maximize the reward that you have. Then you have to have the discipline to be able to follow through. A lot of that game plan should be based on what your daily chart looks like for the stock that you're trading. And again, I'm primarily just looking for a price correction of this sell-off. So where could a price correction give me? It could give me a space between the 8 and 21 EMA. So if I can get this bounce back to somewhere between the 8 and 21 EMA, that's my target. So let's call it 65. But what type of market environment am I in? I'm in a range-bound market environment. I'm not in 2019. I'm not in 2013 where just big upside years. And maybe that's about to change, right? Market environments are constantly changing. Maybe today is the beginning of a catalyst that leads to a breakout for the market, that leads to an uptrending market, and we're no longer in a range-bound market. I need to readjust my strategies and readjust my approach. But the way that I'm game planning trades right now is I'm being a little bit less greedy on what percentage of the position I'm really looking for on the really big moves. And I'm taking more of my stock and I'm kind of working them back and forth for cash flow, which I know is something I've spent a good amount of time talking about in the afternoon meetings as well. And it's not necessarily an appropriate approach for everyone. You have to have a big enough of an account that can enable you to have big enough size. If you don't have size, you can't do it. With that said, I've come up with examples over the course of the last couple of weeks for certain trades, or even someone with a very small account. If you've got, a $10,000, prop account and the buying power that you can get off of that, there's been trades out there where you could easily take 2,000-3,000 shares on some of these earnings names in particular, and they've given you, 10-15 cents worth of risk, and whatever, you're risking a couple $100 on the trade or something like that. So it is possible to have that tier size, that additional tier size, even if you are in a smaller account, albeit it's more difficult because you're a little bit more limited on if the trade requires 50 cents risk, or even like the PayPal trade for me, which is about 30 cents risk, if you're working with a smaller account, you probably can't take 5,000 shares of PayPal off of 30 cents risk. But again, difficult sometimes to balance in the afternoon meeting, the fact that some of you guys have smaller accounts, some of you guys are working in multi-million-dollar accounts, and I try my best to make these afternoon meetings for everybody. But from a game planning execution perspective, what I'm really trying to do with my core position a lot is kind of just work it in case we're in a range. And I've spoken about a couple of ways in which you can do this. You can do this by selling into extension and then buying back at equilibrium for cash flow differences. Meaning, again, let me just try to come up with some simpler numbers. Let's say that you had a 1,000 share original position, you sell 500 at 1-to-1 to cover your risk, you've got a 500 share core position, and then of that 500 shares, every time you see that it gets really extended on the small time frame to the upside, you take 100 shares off, and then you just rebuy that back to equilibrium when it comes back to equilibrium on your small time frame. So now you've got your core position again. In case that big move really does happen, you can hopefully still have it, though you will end up losing pieces of it on the way up. Or if the trade then eventually does fail, like it almost did today, you kept the difference. So like the first thing I did in PayPal this morning when I woke up, I saw that it was gapping up to 61.75, which was a decent gap up. I immediately just sold a small piece of my position, and then I immediately rebought it 25 cents lower, like right as the market opened. So let's just say I did that on 100 shares, all right? And now at the end of the day today, and let's go back to that example. Let's say I had 1,000 shares, I sold 500, I still have 500, and this morning I sold 100 shares at 61.75, I rebought that 100 shares at 61.50. Now, if this trade comes all the way down and fails, and that's all that I did, now instead of my trade being a 0, my trade will be a positive $25. Okay, that's not bad. Again, keep in mind, this is a failed trade, right? So we can live with that. And if you were able to do that twice today, if you're able to sell extension and rebuy, and it was a 25 cents difference, you did it on 100 shares, and you're able to do that twice today, and the thing fails, then all of a sudden, your failed trade's giving you $50, 3 times $75, 4 times $100. That could keep happening. If you look at, I don't know, maybe somehow in PayPal here you were stuck in this range for all of March and April, and you ended up doing it day after day after day after day after day because the thing never broke up to your $82 price target, but it never, rolled over to your, I don't know, $71 stop loss. Just, again, I'm just trying to get the points across here. and every single time you're able to get that little bit of extension on your 5-minute chart, you're selling it and then you're rebuying it and you're kind of keeping the difference. So that's one way to do it. Another way that I sometimes do it, which is what I'm doing in PayPal, is purely based on increments. And you could say every, 50 cents on the way up, I'm going to sell 100 shares, then I'll rebuy it down 50 cents lower. So, if you yesterday, got your 1-to-1 kick at $61, and then you're like, all right, I'm selling another 100 shares at $61.50. I'll sell another 100 shares at $62. I'll sell another 100 shares at $62.50. Another 100 shares at $63, etc., up until I get to my target. But if I sell at $61.50 and then it comes back to $61, I will rebuy that stock. And again, you're basically keeping the difference. So if that trade eventually rolls over and fails like it almost did, every single time you got like a 50 cent incremental move. If you just did it with 100 shares, that's an extra $50 that you're putting in your pocket. So two ways to potentially do that, right? You could just do it based on somewhat arbitrary upside extension, snap back to equilibrium. You got to make sure that the extension is enough and that it makes sense to actually book it there. Or you could just do it purely based on increments, which is what I'm doing. So for myself, I've got my core position in PayPal. I want to hold a piece of it to see if I can get it moved to $64 or $65. In the meantime, though, I'm taking a percentage of my core position, and for me, I'm selling 100 shares every 25 cents. And then I'm rebuying that 100 shares every 25 cents. And I can even show you the executions here, because it's literally like clockwork. My risk is covered on the position every 25 cents. So I sold $61.50. I sold $61.75. I rebought $61.50. I rebought $61.20. I sold $61.50. Am I speaking too fast? Let me start over. I sold $61.75. I bought $61.50. I bought $61.25. I sold $61.50. So look, that's 25. Assuming it's 100 shares, that's $25 in my pocket. That's $25 in my pocket. I sold $61.50. I rebought $61.25. I resold $61.50. If it's 100 shares, it's another $25. I rebought $61.25. I rebought $61. I sold $61.25. If that's 100 shares, that's another $25. I rebought $61. I rebought $60.75. I rebought $60.50. I get stopped out here. Assuming that I just am doing exactly what I kind of explained, meaning I covered my risk, and these are all 100 share increments. I got my risk covered yesterday. Let's assume I did this exactly yesterday also. Let's say I was able to do it 4 times yesterday. So that's $100, and then today, if each one's 100 shares, 1, 2, 3, 4, 5, 6, and let's just say it fails after that. So $100 yesterday, another 6 25-cent increment sales today. It's called another $125. You're looking at $225. Now I've got a trade here, if I get stopped out, that failed. And instead of me being break even at 0, because I recognize that I'm in a range-bound market and have a game plan that's built out to take advantage of a range-bound market, I make $225 on it. And again, that's like not the worst-case scenario. The worst-case scenario is that I bought, an average price of $68 yesterday, and then I got stopped out 5 minutes later, and I never covered my risk, and I just took my full loss on the trade. That's the worst-case scenario. But this is almost the second worst-case scenario, right? Is that I bought it, I covered my risk, it went up a little bit, it never got to my $64, $65 swing target, it came down and failed, I got stopped out. But again, we're talking about a failed trade where, assuming that the way that I'm doing this, and you might not be able to do 25-cent increments because you might not have enough tier size to begin with, maybe you got to do 50-cent increments or something like that, but this is how I'm doing it, is specifically on just these 25-cent number increments. If I get stopped out, and every time I did this was just 100 shares, I'm making $225 in a failed trade over the course of 2 days. Let alone if the trade actually works, right? In which case, then I'm going to make a lot. Or let alone, because we're in a range-bound market, what happens? And look, this is very possible. What happens if this stock just gets stuck between this low and, I don't know, $63 for the next 3 weeks? Is it so unfathomable when the spies just did this? It's really not, right? That's the type of environment that we're in, so it's the type of environment that I'm game planning for. Then I will sit there and let's say that, on average I'm doing, I think I said yesterday was probably 4 25-cent increment sales. I really don't know what the number was. I just made that up. Today was 6. Assume on average it's 5. Every single day I just am sitting here in this range, putting $125 in my pocket, assuming that they're 100-share kicks, and just doing that and doing that and doing that and doing that. Since you're adding size higher, I'm not adding size. It doesn't increase my risk. I'm not adding size. I'm rebuying what I sold. So again, if I had a core position of, let's just say 500 shares, right? Which for my example, it's not going to be realistic. I have to have more than that or I wouldn't be able to do this. But if I had a core position of 500 shares and I sell 100 shares, I have 400 shares. If I rebuy the 100 shares, I'm back to 500 shares. I'm never getting heavier. I'm never getting heavier. If you get heavier, you can potentially turn a winner into a loser. So you are never adding on additional size after the core. So you've got your stock, you sold to cover risk, the remaining stock is your core. If you choose to sell 100 shares 50 cents up and then buy that 100 shares 50 cents back down, you're back to your core. And the only difference will be that you keep $50 at the end of the day if this trade rolls over and actually stops you out, right? And I probably wouldn't have as aggressive of a game plan to do this if I was in a trending market. But I'm not in a trending market. I've got all these stocks in all these markets that have just been going sideways and have just been range bound and range bound and range bound. And the way that I'm looking at it right now, with how I'm positioned with this market, to be totally honest, is if we break out, awesome, I'm long the world, I'm going to get paid. If we go sideways, okay, fine. I'll just work these ranges just like I showed you guys over and over and over again, putting money in my pocket every day until it either eventually breaks out or it rolls over and triggers my stop loss like PayPal almost did today but didn't. And then I'll, manage my risk, and I have a situation where I have trades that are failing and I still was able to make money. But maybe I did this for 2 months in a sideways market here ahead of time. So if the market wants to stay stuck in this range, and I know it's frustrating for people, it's frustrating looking for new trades, the new trade aspect of it's been pretty difficult, but every time I can get a PayPal on where I get my risk covered, I got one more position here that I can do this with, and I can just continue to add cash flow into my pocket every day while we're in this range, to the point where if I'm able to do that with 16 positions and net a good amount of money every single day just by doing that, I could care less if we stay in this range forever and every single momentum trader that I know is pulling their hair out because they can't get moves. Which I would still argue that there actually has been plenty of great individual stock moves out there if you are focusing on the right names in play every day, even while the market's been in this range. But yeah, kind of just wanted to throw it out there. I wanted to talk about market environments. I wanted to talk about game planning and various approaches that you could be implementing to your game plan to add on to what you're doing. That's all I got. So I've been answering questions. I want to start with any questions that are specifically related to PayPal, when I just spoke about, which I think are coming from Steve and Ricky. From Steve, PayPal, but really any name, you are really good at getting. You're really good at getting good entry prices. Thank you. Which I think enables you to have wider stops and still be profitable, or at least not down as much. Can you speak sometime more about your strategy for getting best entry prices possible? I know it's an involved question, but would like your advice anyway. Sure. I mean, all I do is, so execution is really important. I 100% agree with you. The difference between having good execution on an idea or good execution on a trade and poor execution on a trade is very often the difference between that trade failing and being break even or being profitable. You know, a trade that works is a trade that works. Like, you know, you buy a stock and went up, congratulations, it's not that hard. I really think what separates traders primarily, this is a little bit too blanket of a statement, but I really think the thing that separates traders primarily is not when their trades work, it's actually when their trades fail. Because again, you bought the stock, it went up, congratulations. I would still argue even in that case that good execution matters, because if you have good execution, you might have more size. And if you have more size, you're going to get paid more on the trades that actually work. But broadly, even if your execution is not as good as mine, but the trade works and the idea works, we're both going to make money. It's when trades fail, that's when execution really, really matters, and sizing and how you build into it. And I don't have a blanket answer for you on good execution, because I think it's very much trade specific, the type of trade that you're getting into. And I also think that the type of trade that you're getting into dictates how you execute it appropriately. And that's why, like, what name was it this morning? Laser. What did Laser end up doing today? I stopped watching after I missed my trade. Ooh, it failed. But it doesn't matter that it eventually failed. It gave a decent move ahead of time. I remember typing up this Laser here when it was trading at like 688, I think. And I chose not to buy it because I didn't think the execution was good enough. You know, the big picture alert from my spreadsheet says long versus 650. We've discussed this in the past, right? That's based on daily chart research, and then sometimes you need to adjust what that should be based on how the trade actually sets up. So the volume here looks good. It opens up high. If I could have gotten a price on this first bar of like probably 682 or better, I would have taken stock, and I probably would have just taken it versus lows and just put on like 12, 13 cents worth of risk. By the time I typed it up, it was trading at 688, 689. I missed the trade as far as I was concerned. That's not good enough execution for me. Because if I'm in from 681 and I get a move to 694 and then this little pullback here leads to failure, that's a break-even trade. If I'm in at 688 and it goes to 696 and then pulls back and fails, it's a failed trade. Scenario A, I have good execution, trade fails, I make him lose nothing. Scenario B, I have bad execution, the trade fails, I lose. And then again, even if the trade actually scenario B, I'd probably have less tier size because it was more sense risk, so I couldn't take as much sizing. So execution really matters, and if I feel like I'm not getting the execution I want, I either don't take the trade entirely, or if I really, really like the trade, then I'll take like a feeler position and see if I can find a way to be able to get more size with better execution. So execution is huge, but I also think it depends on the trade type. You know, if you're buying a breakout, you're buying through the level. This is more of like a breakaway gap trade on earnings, a little bit trickier on the execution. Or if you're buying that, you know, or yesterday was just an RDR. I didn't do anything special. I didn't do anything special in PayPal on yesterday's trade. I didn't do anything special. I mean, all right, maybe the fact that I bought a small initial position at $60.51 is great price, but more difficult execution. But buying back through 60.75 versus the low, I mean, it's just the RDR trade, right? It's really simple execution. And in that case, you know, my average price, like I said, was like probably 68 or whatever. In this case, your average price is 75. So you have a little bit of a worse price. And that will matter, actually, because this is another situation where if your price was 75 versus your price being 68, it's probably the difference between you getting your one-to-one kick at highs at 940 versus you not. And I remember actually one of you guys in the afternoon meeting, you didn't get your one-to-one kick and cover your risk until like $11.15 because that was, and I had it by $61 because my average price was a little bit better. But you know, for the most part, you just got to make sure that you're in at the right, you know, following the rules of the trade. The trade governs, the type of trade governs the execution of the trade. That's one of those things that I'm trying to separate with you guys, is like pieces of information and layers of probability versus trades. The trade is what actually gives you the execution. So yeah, so I appreciate that as a compliment. But I think that's the bottom line, is that the trade gives you the execution. And then when I'm looking at those counter trend trades, like I do sometimes, you know, I'm taking like those 5-minute RDRs, right? Like I've talked about that a lot. That's also relatively simple execution. What was not simple execution, and probably not right for a lot of people, was Netflix today. That's not simple execution, because, you know, and Pat does this also, where at a certain degree of extension at a certain time of day, we'll start to, you know, build in small into a trade and then look to kind of be able to get a little bit heavier on that, having like a very strict defined out necessarily right away. I'm like waiting for the pivot to tell me where the stop is supposed to be on this thing. That one's much trickier. But Ricky with a PayPal question: if PayPal went sideways for a few weeks, would you be loser with your stop because of profit cushion? I don't understand the language in the question. Would you be loser with your stop because of profit cushion? Oh, looser. God, I can't read. That's a great question. That's a great question. Maybe is the answer. It kind of depends on how I want to trade. I do that sometimes. That's actually like kind of the next level of what I'm describing here, and that's kind of what my game plan is in Lemonade and Carvana right now. Oh, and AI, I forgot all about AI. What did AI do today? Oh, tell me my internet just died again. No, looks like I'm good. So I've got like a really nice profit cushion in Carvana right now. CVNA. So there's like a couple of things I'm doing as kind of like a little more advanced level of what we're describing. So in theory, right? So one thing that you could do, let's just go back to PayPal. We talked about how we came up with this kind of somewhat real, somewhat hypothetical example of working ranges to the point where you made $225 on this thing, and now it's coming down to yesterday's stop loss and you're about to get stopped out. And now instead of a break-even trade, you made $225. Well, you've got, we said, 500 shares, right? Well, if you made $225 and you've got 500 shares, you could, your new break-even, you want to think about it that way. So like, this is your old break-even price. This is your stop loss. You're going to make $225 if you get stopped out. Your new break-even price is going to be an extra 45 cents lower, right? If my math is right. Is my math right? $225, 500 shares. Why am I blanking on my trader math? It's embarrassing. But whatever, it's called 45 cents. So in theory, what you could do is you could build out the game plan to actually bring the stop loss lower to always be at 0. And I do this sometimes. I mean, now instead of loss to 60, let's just call it 40. Let's say I've made enough money that it brings my donut price, where I'm a 0, down to $60. I might adjust the stop down to 60. And then I would also have to build into a game plan of, now I'm actually probably going to buy an extra 100 shares at 60. I want to keep the 25 cents going. So that means that if it's supposed to be 45 cents, it's probably going to be a little less than 45 cents, maybe more like 40 cents. Again, you could do all this math in a spreadsheet. So now you're down at 60 bucks there, and you're working it versus 60 versus working it versus yesterday's low. And then on the occasion where you do get a shakeout stop loss type of situation, if this pullback today broke yesterday's low, and then snap back up, you're actually still in the position. Maybe you're even getting filled other people's stops at 60 quarter. Your stop's at 60. It bouncing and snap. For a long time now, I've actually talked about that in afternoon meetings in the past, where my break-even price and snap is like $5. So, is that the all-time low? Nice. So I'm golden in this thing by doing that. Another thing that you could do, which is what I'm doing in like Carvana and like a Lemonade, is you can actually, if you're willing to risk what you've made, and this is what I love doing, like I think all the time about risking money that I've already made, not risking money. I hate risking money. There's nothing worse than when you buy PayPal yesterday and you buy holding in to the position again into this equilibrium zone, saying to myself, I'm going to risk what I've already made in it. And now that $1,000 can become $2,000, can become $5,000, or I'm back to being donut. So it depends on your risk profile and you know how much you need the money. You know, you could going back to PayPal again. You could just get stopped at yesterday's low and keep the $225, or you could take the $225 and extend the stop loss to try to extend the trade to give you more space to continue to work it to potentially make more. It's risk reward, right? One is you're going to risk giving back less money and less money. One is that you're going to give back more and be able to stick in that trade longer. So a really good question there, Ricky. I really got to go soon. Let me try to get through some questions that I'm still long, but my broker is telling me that I'm actually up on the position due to collecting the premium from the short puts. My default trading plan would be to sell it all and then short some $6 puts. Keep the trade going. Is there anything you can see on the Nat Gas daily chart that would indicate that I should instead and try to sell them higher? This thing's breaking out. I mean, yeah, this thing just broke out. I'm such a wimp for not pulling the trigger on this UNG trade. When resistance really till like 8, and then curious, do you have like, you know, it's hard for me because I need to balance what I do with what I preach. I really, really, really don't think it's a good idea for someone who's more entry level or in a small account to trade without a stop loss in place. I do it. But when I do it, I make sure that the position sizing is appropriate. So I know that I can afford, if I end up having it stopped out at 104.93 yesterday versus 104.63, I know that I'm going to be comfortable with the difference. Sometimes it's not good, even for me. You know, there are definitely times, there's been a few over the course of the last couple of months, where I lost a little bit more than I kind of wanted to because of that. It was never like a beyond a worst case situation for me that I was uncomfortable. It was just like, I really didn't plan on losing, I didn't really want to lose this much on it, style, and not having that stop loss in, and that's why I highly encourage, because if you've got too much size on, and I've done this too, you got too much and you don't have that hard stop in place, then you can do a real damaging hit to yourself. From Coffee. And this will be the last question because I really got to jump. If I sell limit orders in place on a long trade and have sold stock on an overextension, when I try to rebuy lower, the system tells me that I cannot cross my own order. To add back, I have to cancel my limit, sell orders, and then I can add. But that takes time. I don't have an issue. I don't know what to tell you. This sounds like a trade support thing. I don't have any problem doing that. I don't have this cross your own order issue. So I don't know. You should contact trade support team about it and see if there's anything that they can do. All right, gang. Hope everybody learned something. I gotta jump. Have a great night.